Our next topic is the main books of accounts. The learning competency in this lesson is to identify the uses of the two books of accounts. Learning objectives. At the end of this lesson, you should be able to do the following: describe the types of journal and ledger. Determine the types of journals and ledgers for transactions. Identify the advantages of using a specific type of journal or ledger. At the end of our discussion, you will be able to answer this essential question: how can a business keep accurate and systematic financial records? Now let's start our discussion by defining books of accounts. Books of accounts are used to record transactions and are vital for organizing, summarizing, and reporting these transactions in financial statements. The books of accounts are registered with the Bureau of Internal Revenue for compliance and monitoring purposes. We have two main types of books of accounts, namely journals and ledgers. The first type is journalizing. Journalizing is the process of recording the business transactions to the general journal, while posting is the process of transferring or summarizing the transactions from the general journal to the general ledger. In the first phase of the accounting cycle, transactions are analyzed according to the rules of debit and credit and are then recorded in the journal following the double entry system. Transactions are also recorded according to the date on which they occur. The ledger serves as an extension of the journal. The ledger classifies transactions recorded in the journal to an account to compute the account balance. The balances of the accounts will be used to prepare the trial balance and subsequently, the financial statements. A service business keeps 4 books of accounts, namely the general journal, general ledger, cash receipts journal, and cash disbursements journal. Let's now focus on journal. The journal is a record of the business's transactions in chronological order using the principle of debit and credit. It is where a valid transaction is recorded for the first time, hence a journal is also referred to as the book of original entry. Businesses record economic events daily to preserve the accuracy of financial data and make it more effortless to organize and transfer the information into the ledgers. A record in the journal is called a journal entry. Transactions are considered valid when they have monetary value, are supported by source documents, and have debit and credit effects. Again, a journal is also known as the book of original entry or first book of accounts. No transaction will make it to the ledgers and financial statements without being entered into a journal first. A record in the journal is called a journal entry. If a transaction is composed of 1 debit and 1 credit, it is called a single journal entry. On the other hand, if a transaction has more than 1 debit or credit, it is referred to as a compound journal entry. In recording transactions in the journal, the debit account is written on the far left, while the credit account is indented to the right, a few spaces from the debit entry. A short description of the transaction is also written after the credit account. There are 2 types of journals, the general journal and the special journals. A general journal records transactions using the journal voucher system that cannot be recorded in the special journals. It is the simplest form of a journal. On the other hand, special journals are designed to simplify the classification and summarization of accounts from recurring transactions. The common examples of special journals are the following. First, sales journal, used to record sales of goods or services on account. The second one is purchases journal, used to record all purchase transactions on credit. Next is cash receipts journal, used to record cash sales of goods or services and cash collections of receivables from customers. And lastly, cash disbursement journal, used to record cash payments of expenses and payables. The ledger is a book of financial accounts that reflects the economic effects of the business organization's transactions after they are posted or recorded to the various journals. Transactions are recorded for the last time in a ledger, Hence, it is also referred to as the Book of Final Entry. The ledger is used to prepare financial statements and includes a list of all the accounts. The ledger is affected by regular business activity and can be recorded by hand or through an electronic document. There are two types of ledger: general ledger and subsidiary ledger. A general ledger summarizes the activity for each organization's accounts from the journals. This book is where the entries from various journals are being posted. On the other hand, a subsidiary ledger includes details of various accounts such as accounts receivable and accounts payable. They are kept separately to better control accounts in the general ledger that need extensive monitoring. The subsidiary ledger breaks down the total amount reflected in the general ledger into parts, per customer for the accounts receivable and per supplier for the accounts payable. To wrap up our advanced discussion, please keep in mind that the Book of Accounts is used to record transactions happening in the course of the business. These events are inflows and outflows of day-to-day economic activities that a company typically does in its operations. The two types of books of accounts are journals and ledgers. A journal is used to record business transactions. A ledger is used to provide an organized list of accounts that are used to prepare financial statements. Business transactions are recorded in the general journal and special journals. For specific records, cash receipts should be recorded in the cash receipts journal, cash payments in the cash disbursement journal, sales in the sales journal, and purchases in the purchase journal.